Investors see red as President Trump risks reigniting a trade war with Europe over Greenland. European leaders pledged to hit back with Trump threatening new tariffs, but what moves can they make? Live from Sydney, I'm Paul Allen. This is Insight, diving deeper into the stories that matter with sharp context and crucial analysis.
We are the hottest country in the world. We are the strongest country in the world. The Europeans project weakness. The U.S. projects strength.
It's Treasury Secretary Scott Bessent there saying the US will not back down on taking over Greenland, saying Europe's too weak to ensure its security. So why does Trump want Greenland so badly? We'll ask Arctic security expert Troy Bouffard about that and how far he thinks the president's going to take this. Meanwhile, China manages to beat the tariff pain with economic growth meeting the government's 2025 target. We'll discuss the challenges, though, that are still hobbling the outlook. And we hear exclusively from the CEO of Indian IT services giant Wipro after the firm reported weaker than expected earnings. All right, it's a risk-off move for Asian markets. This is after President Trump's latest tariff threat to European allies, really ramping up the pressure to acquire Greenland. US and European futures are sliding. Traders are flocking to haven assets. We've got gold pushing to a fresh record, now above the $4,600 level. Look, elsewhere, we did have some encouraging data out of China as well. Those GDP numbers coming in line with estimates, 4.5% growth there. Retail was pretty soft, but industrial production was a bright spot. We'll take a closer look at that a bit later on. Japanese bonds, meanwhile, are slumping as a food tax cut talk really starts to adding to this election risk, which is yet to be called at the moment, probably going to be in early February, however. Right, let's get the latest developments now on Greenland, though. Get to Bloomberg East Asia government editor John Herskovits. So, John, how are European countries responding to President Trump's tariff threats?
We're seeing three different things that are coming from Europe. One is the trade deal that Europe reached with the U.S. about 6 months ago. This hasn't been approved by the EU Parliament, and it could be delayed or halted. We've also seen France and other European countries looking at using what they call the bazooka when it comes to trade, the anti-coercion instrument. This would allow them to target specific U.S. products, and it could really impact U.S. tech companies doing business in Europe. Also, European countries are looking to revisit a 93 billion euro list of items that could be subject to trade tariffs from Europe, U.S. items which could face difficulties coming into Europe. So we see these three things. European leaders are due to have a summit this week. And also we have Davos coming up this week, where there'll be a lot of power concentration, political, economic. So these three measures, and also we have the diplomatic and the political talks that are going on with Europe now.
Yeah, so at the moment, tension and rhetoric really seems to be ramping up. Are there any plans to wind things down, look for a more diplomatic solution?
Yeah, as we saw at the top with the comments from Secretary Bessent and Trump's threats of tariffs, there doesn't seem to be anything now to wind things down. Now, last week, the U.S. had talks, high-level talks with Greenland and Danish officials, which will continue. So the diplomatic path is there, but the rhetoric's just getting more heated. And there are possibilities for an off-ramp for this. There's a 1951 defense treaty that allows the U.S. to put more military assets in Greenland to do the type of security monitoring of missiles, shipping lanes, which could be part of this, which are something that the U.S. is looking to do. And also the talks that are going on with the U.S., Greenland, and Denmark could include some things about mineral exploitation, helping the U.S. and Trump reach this goal of finding more rare earths and critical minerals. So off-ramps are there, but it doesn't look like anyone's taking these off-ramps at this time.
How about the U.S. Congress, John? Is it doing anything to lower tensions?
We're seeing some rhetoric on both sides of the aisles from Republicans and Democrats, some sort of pushback to this. We haven't seen any concrete action yet, but the leaders of the Republican Party are joining Democrats and saying this is a little bit too far. We could see Congress trying to use its authority to curtail Trump when it comes to tariffs. It hasn't happened. It's part of the rhetoric. How far it will go, we don't know yet, but yeah, the Republicans are showing some signs of pushing back, and the Democrats have already pushed back. So nothing from Congress, but there are murmurings going on now on Capitol Hill.
All right, Bloomberg East Asia government editor John Herskovitz there. Joining us now, we have Troy Bouffard, director of the Center for Arctic Security and Resilience at the University of Alaska Fairbanks. Troy, thanks so much for joining us today. And I want to start, if I can, with perhaps the most obvious question. Why? I mean, Denmark, which looks after Greenland, is a NATO ally. John was describing there some of the illegal avenues that the US could pursue to get what it wants. You know, there could be a negotiated agreement to build or install more military installations, rare earth mines, provision for the Golden Dome. Why such an aggressive approach?
Well, thank you, Paul, for having me. And, you know, I think what was just mentioned is all true. But the context is kind of important here, obviously. These are legitimate national security priorities for the United States. Two main ones, which is North American defense and the rare earth elements are something that's not being talked about as much. And I think that part has got most of the concern from the White House on how that might work out. I believe, ultimately, the White House would like to secure some kind of commitment from Greenland that it will exclusively partner with the United States on rare earths. And that's our need to directly counterbalance China's access to an enormous reserves of critical minerals on their own mainland. And so this is the future of innovation, defense tech, and so on. We really need to find a solution for rare earths. Greenland offers that solution, and I think the White House is mostly focused on securing that kind of commitment and partnership somehow. We're just seeing this play out differently from President Trump, who relies more on his skills regarding business versus foreign affairs and diplomacy, right? So I think that's what's got everyone frustrated here. My hope, my belief is if they can negotiate to something towards that commitment, that'll be the win the White House needs and perhaps the end of this rhetoric.
Yeah, I think nobody would disagree that diversifying rare earth supplies is an important priority, but do you really need to blow up NATO to do it?
No, but I think President Trump is relying on his business skills purely to drive this effort. And what we're seeing, much like you cannot run government like a business that has limits, you also can't run international affairs like a business either. However, there seems to be some utility in articulating what looks like a hostile takeover. And normally you'd keep that a secret until you pull the trigger on such a thing in the business world. Well, to make that work in the foreign affairs world, perhaps in this situation, I think we're seeing something of that, creating that power position that you need in business to negotiate the strongest deals. I think we're seeing some of that play out in what might be the equivalent of a hostile takeover, but in this sort of bizarre approach that's being used right now.
Yeah, the term rare earths is sometimes misleading as well because they're not particularly rare. They just don't occur in tremendous concentrations. But you know, Australia has huge rare earths reserves, existing mines. Just last October signed a framework agreement with the United States to exploit them. Again, why blow up NATO to get to Greenland? It just doesn't seem to add up.
It doesn't, but I think that President Trump is not that interested in international relations following the normal process of foreign affairs and diplomacy. In his world, his expertise is business strategy and tactics, and that's what he's using, and it's the only way he knows how to translate to get to this deal, get to the goal that he's pursuing. Everything else is going to probably suffer as a result, or it will have to be remedied after the fact. He seems purely focused on striking this business deal under his terms.
Well, we also heard from the Treasury Secretary, Scott Bessent, as well, making some, I guess you could interpret them as unhelpful remarks about Europe, calling it too weak to look after Greenland. So let's just take a quick listen to what he had to say.
If there were an attack on Greenland from Russia, from some other area, we would get dragged in. So better now, peace through strength, make it part of the United States, and there will not be a conflict, because the United States right now, we are the hottest country in the world. We are the strongest country in the world. The Europeans project weakness. The U.S. projects strength.
By the same token, could one argue that NATO projects strength as well? Because, again, all of these countries are NATO members. Why can the U.S. not just place military there now?
And more than ever, NATO is stronger than it's ever been, for sure. I stay very focused on this business analogy in this case, and prior to negotiating the final deal, it's common to create the most powerful position in order to negotiate from strength. And I think all of these signals, the rhetoric, the sort of hostile takeover articulations and behavior is all part of this. He doesn't factor in the damage to relationships, isolation of the United States, and losing allies. It's a zero-sum game for him, with not much appreciation for international relations and foreign affairs.
We've had a few case studies prior to this about how to deal with President Trump's often aggressive approach. I mean, China famously didn't even pick up the phone until a sensible discussion on tariffs was in the offing. Could we see something similar out of Europe? Those EU member countries so far that are involved in this, Britain as well, showing no inclination to back off on the tariff threat. And then, as we heard John Herskovits mention a moment ago, there's always the anti-coercion instrument as well. Is perhaps the scene being set for another taco moment? A Trump always chickens out.
Yeah, compellence is definitely at play here. With the tariffs, I think about this is sort of unprecedented territory for everyone. And I think Europe is playing a smart strategic move here by not waiting for the end result and how this may play out in terms of how long obligations and current contracts they may exist regarding tariffs, and then renegotiating from that position. It seems to me they want to actually move forward, not wait for that situation, and try to retain some kind of control over this tariff situation. And that makes sense, right? I think all this is at play. Europe is creating a united coalition in front on these issues right now. And I still believe there's a negotiation room like off-ramps that were just talked about, though.
Well, a lot of the key players are going to be in Davos this week, including the president. Do you anticipate anything will come out of those conversations that might find a more productive path forward?
Yeah, I'm hoping, the defense discussions should be simple. This is old partnerships we've had for a long time. I think once the discussion pivots towards the rare earths and start really getting at the meat of what's desired here, and commitments and negotiations can start form around something that appeases the White House, we could see some quick movement there. As long as President Trump can save face, claim victory, I think we can get out of this.
It's interesting that you're joining us from Alaska, actually, because, of course, Alaska was purchased by the U.S. From Russia way back, when was it, 1867, for the princely sum of $7.2 million. Is there any lesson from history here that could be applied to the Greenland situation?
This is, Alaska is a boom and bust economy, and that was largely driven by population increases during certain times when you had the gold rush. Then you had the World War II and the invasion of the Aleutian Islands, and then Cold War, which really stabilized a larger population here in Alaska. And I see similar situation for Greenland too. That's dealing with population and national security needs and defense needs, kind of driving the importance of the entire island and its population and its relationships. So we kind of understand this from the north. We're part of the North American defense from Alaska all the way to Greenland and over. We're in this together. In practicality, we always have been. That's why it shifted from the U.S. European Command in DoD to the U.S. Northern Command this year. So they're practically a big part of our national defense, our North American defense. The threat is changing. right? It used to be about ballistic missiles in the Cold War. That's not really the case anymore. Although that threat still exists, that was land-based launched missiles, and we are now dealing with a new threat known as hypersonic cruise missiles that are air, land, and sea launched. And every single vector throughout the entire Arctic now becomes part of the scenario of attack, as the Arctic is the shortest avenue of approach, right? So this is why Greenland has all of a sudden become really important to North American defense. The threat change, it's technology. Now we got to build this Golden Dome. It's a completely different defense system that's going to be space-based. And that presents extreme challenges to us up here because high-latitude satellites don't work very well up here. They're not reliable enough for missile defense. Right? So we have some daunting technological hurdles to get over before we could figure out what Golden Dome is going to look like in the future. And most assuredly, for the North, we're going to be probably the biggest part of the early warning system of it all. But we're a long ways away from that.
It kind of brings us full circle, though. I mean, again, one imagines there wouldn't be too much disagreement among NATO member countries about the need for this. So why can't there be a more cooperative approach?
I think the defense side is exactly like you said. This is a no-brainer. There's no problem there. We can adapt through the existing partnerships and treaties to any changes in the threats, which we already are. The Arctic is a textbook gray zone of hybrid-type activities and threats. We're all learning this. The Danes in the Joint Arctic Command and those elite operators in the Arctic, they're extremely good at this. They've been doing this for a very long time. They understand these kind of activities and how to deal with them. We're still learning here in the United States. Right? We haven't operated at that level, and we need to rely on our allies, our oldest ally, Denmark, to help usher in this new age threat for us that's going to be part of the next several generations, and do this as a team. Right? The team is what got us to success throughout the entire Cold War. Right? And I think that's in the United States' best interest right now is to strengthen that team, NATO, NORAD, and otherwise, in order to be best positioned.
How do you imagine this dispute is currently being perceived in Beijing and Moscow?
Well, I think Moscow absolutely adores this situation because they're all about irredentism and claiming lost territory in the past. So they're in support of these kind of behaviors. China is all about this too because this looks like the rules-based order that the United States used to represent and try to lead globally, that we're not paying attention to that anymore, right? So as the world order changes, with China doing everything it can to define what that may be in the future, this is working out very well for our adversaries.
Yeah, what are the implications in terms of how Russia approaches its ambitions in Ukraine and perhaps beyond, or China approaches its ambitions relating to Taiwan?
Yeah, that certainly puts us in a situation where we're dealing with multiple fronts and contingency situations around the world, and especially with the Arctic. We have some ground to make up in the Arctic in terms of developing our operational capabilities, right? And it's a shared space for the United States military, which presents some command relationship challenges, just unilaterally amongst ourselves. And then when we start working with our allies in NATO, it gets complicated, and we need to be working together. We need to be training and exercising and testing our plans to operate in the North for expeditionary type activities, hybrid type threats, and other activities like that. And then someday, perhaps even get to a level of large-scale combat operation capabilities, although we're pretty comfortable at this point understanding that the Arctic, for anything that might happen in the northern hemisphere as far as conflicts or crises, the Arctic will largely play a periphery role. Very likely going to be part of that, those kind of situations in the future, but these are the kind of things we should actually be training for. We've always worked together in the Arctic because we understand it's too difficult, it's too expensive, it's too dangerous to do anything alone. And as we build up our Arctic operational capabilities in comparison to Russia's, we have a long ways to go. Right? Although they're completely flatlined now because of Ukraine, when they do come back, they're going to develop very fast.
All right, Troy Bouffard, Director at Center for Arctic Security and Resilience, also former Arctic advisor to U.S. Senator Lisa Murkowski. Thanks so much for joining us today with your analysis. Now, we still have more ahead this hour. India's third most valuable company reported third quarter profit that underwhelmed investors, blaming sluggish growth in the petrochemical and retail businesses. We'll have more details on Reliance's earnings up next. This is Bloomberg. Welcome back. You're watching Insights. We will be watching Reliance shares at the Indian Open after the conglomerate posted weaker than expected profit on sluggish growth in its petrochemical and retail businesses. For more details, let's get to our conglomerate's reporter, PR Sanjay in Mumbai. So Sanjay, how do you read the third quarter earnings from Reliance?
Sir, as you rightly pointed out, the conglomerate, retail to refinery conglomerate, has posted, it actually missed the street estimates because of the weak petrochemical business and retail. Because the retail business, the festive quarter of India was spread into 2 quarters, so hence it could not reap the benefit what it was expecting originally. And of course, petrochemical businesses were impacted due to various geopolitical things. But like a true conglomerate, it's a technology business, which is Geo Platforms or Reliance Geo Infocom, which is a wireless carrier business, and apart from the telecom business, various other factors also help Reliance Industries to post decent profits, and it has never disappointed in earnings. And Reliance have maintained its earning estimates, and it is the cash profit which is maintained had proved that the coming quarters, the capex will be strong cycle, and Chairman Mukesh Ambani has highlighted about the rating agency, how rating agency have affirmed, how they have acknowledged, have they endorsed the capex plan for Reliance Industries, and they've also updated in the presentation. They've also updated the rapidly progressing plans for BESS, which is Battery Energy Solutions System, and cell manufacturing units.
So, Sanjay, what's the market expecting to hear in the coming days?
Oh, that's a great question. So 2 things. One is the biggest IPO they're expecting, which is Geo Platforms Limited. The market is expecting when will they file the draft red herring prospectus with the regulator, which the entire market is looking. And secondly, the major thing is, since there's no Russian oil purchase from Reliance, they're waiting. Reliance have publicly said they're waiting for the clarity of whether they can buy oil from Venezuela or not. So that is the next key thing which market will be expecting when Reliance, they're keenly expecting the commentary. Street is expecting the commentary on these 2 aspects from Reliance Industries, which is one of the largest private company in India.
All right, Bloomberg conglomerates reporter PR Sanjay there in Mumbai. Still to come, Boston Consulting Group's head of APAC Tech and Digital Practice is going to tell us why Asia's moving faster on AI, with China and India leading the charge. We'll have more details on that story ahead. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand. We do have mainland Chinese markets heading to lunch. Japanese traders coming back online. And we're seeing a little bit of weakness pretty much across the spectrum. Bit of risk-off sentiment. The Nikkei off by about 1%. Similar story in Hong Kong. The Hang Seng Index off a little bit more than 1% as well. The CSI 300 softer by 0.25%. In terms of China, we've just heard from the National Bureau of Statistics. A little bit of optimism here following the data that we had before. The consumption demand expected to grow gradually. This is according to China's NBS. This is after we saw some pretty weak retail figures for the month of December. Again, China NBS saying food prices partly fell due to weather conditions, but the spring holiday is conducive to a seasonal recovery of prices. And the Bureau of Statistics growing positive on factors supporting consumption as well. So those are some of the headlines coming from the National Bureau of Statistics at the moment. Well, let's get to a specific corner of the market. Software stocks. They're off to their worst start in years, and that is following the release of a new AI tool from startup Anthropic. Asia Tech correspondent Annabelle Drewlers joins us with more on this. So, Belle, the new year was supposed to bring opportunities for this sector. It's not really working out.
No, certainly not panning out maybe the way that some of those investors would have liked to have seen, but essentially, yeah, software stocks are having their worst start to a year going back to 2022. What we're basing that on is a Morgan Stanley gauge that looks at software as a service stocks, essentially. So that's sort of a by the by, but just the main thing to understand here is that software as a service, companies essentially make their money from hosting the software, but then charging customers annual subscription fees, or a lot of the time, for their technology. So that's, of course, been a really profitable trade for these companies for a long time, or a profitable business model. But essentially what's happened is that in the age of AI, that's certainly being tested, essentially. So the latest bout of selling that we've seen to start the year is after Anthropic released this new AI tool, and it's a platform, of course. Anthropic, it does particularly well with enterprise clients, even though it's much smaller than the likes of ChatGPT or OpenAI, for instance. But this new tool called Claude Cowork was released just a few days ago, and I won't get into too many details on it, but just to say it essentially can perform file management, basic computing tasks. It's in beta mode right now, but so far the reception to it has been pretty positive. And so it's also important to track that this new Claude Cowork tool was built essentially using AI tools. It was built also in a pretty short amount of time as well. And so that's really given a lot of fear to investors in these companies, because software stocks, as I said, they've been an investor favorite for quite a long time now. But what is the risk here that's being posed by these AI companies, essentially, that can operate these agents 24/7? They can build the tools in a short amount of time as well. And what kind of challenges do they pose to the traditional software stocks in the market that have had big profit margins and recurring revenue streams as well?
So where to from here for software stocks? Do they need to pivot or face worse to come?
Yeah, that's sort of one of the big debates that we're seeing right now amongst analysts. I think many are saying that it's really difficult, essentially, to price growth for these companies moving forward. There's obviously a divergence between what you see for the broader tech gauge and then software stocks in particular, because we were just showing that chart, for instance, a bit earlier. But you've got the NASDAQ sitting around record highs. You've got the software as a service gauge and names like ServiceNow, for instance, in that gauge, trading around their lowest in years. So the problem is that a lot of these companies haven't really got that far with their own AI offerings. So Salesforce, for instance, it's released and it's really trying to talk up its own AI tool. That's the Agent Force product, but we haven't really seen it significantly moving the needle for revenue. You've got Adobe as well. You can see there that slump 15% year to date, but it's also got Gen AI features that are being embedded into its video and photo editing software. But again, we didn't even get much clarity on those in the latest earnings as well. So essentially, we've got earnings that are expected to slow across the board into 2026. Valuations are continuing to look cheap as well for these companies. Are valuations, though, the reason that investors might want to start to move into the market? I mean, Barclays, for instance, is saying that software stocks could actually end up catching a break this year with customer spending looking stable, and the stocks that, as I said, they're looking cheap. Goldman Sachs as well is looking at sort of that broader trend of AI adoption across the market, and they're saying that actually that could increase the total addressable market as well, and so that could actually end up being a bit of a tailwind for some of these software names. But essentially, maybe not, I would say, just screaming a buy just now, but maybe it could be a trade that some look to enter into in the coming months.
All right, Bloomberg Asia Tech correspondent Annabelle Jewell is there in Hong Kong. Well, let's stay with AI, and findings from a Boston Consulting Group study suggest about 3/4 of CEOs say they're now the main decision makers on AI in their organizations, and half of them believe their jobs depend on it. We'll get some more insights now from Jeff Walters, head of APAC Tech and Digital Practice at Boston Consulting Group. Jeff, thanks so much for joining us today. And I just want to pick up on a theme that Annabelle was talking about there in terms of software as a service and how AI might be eating its lunch to a degree. I mean, we do have a chart on the Bloomberg that illustrates this. I mean, the NASDAQ's doing really, really well. Software as a service, not so much. Those two lines diverging there. Do you feel like there might be some trouble ahead for companies like Adobe, Intuit, Salesforce, as agentic AI just gains more and more traction?
Thanks, Alan. Well, what we do know is that we are just at the very early days of how large enterprises and companies are using AI to transform how they do their business and how they compete in the marketplace. And I would say from CEOs, what we are hearing is we are at still the very early days of how they're going to use this technology and get benefit from it. Now, where there can certainly be shakeout, and we have a lot of investment while increasing demand, is on all parts of the AI stack. Right, so indeed, I think we're going to see some volatility around which players are ahead at any given time.
Are we seeing a similar trend perhaps in Asia as well? I mean, we've got the very hardware-heavy indexes in China performing well, Alibaba and Tencent sort of starting to lag a bit. So do you see this as being a global phenomenon?
Well, what we see, and when I talk to CEOs around the region, is we certainly see a higher level of ambition in Asia Pacific and a larger sense that AI is going to fundamentally transform my company. We hear this more from leaders and CEOs in Asia Pacific than we do from other parts of the world. What we also see is a recognition that there is top technology coming from all parts of the world now. So when I look at the AI stack, indeed, we have very strong models that come out of China. We have, of course, strong models that are coming out of the US. And so there's an increasing sense, I'd say, number one, there is the ambition to transform my company with AI, which happens even more here in Asia Pacific than in the rest of the world, right? And number two, certainly a willingness to look at technologies from around the world. So both of those things are playing out to some extent to Asia's favor.
Your report also points out that AI is no longer a side experiment for a lot of companies. Investment is increasing. I just wonder what you could tell us in terms of what you're seeing in terms of increased productivity and how that's translating into improved profitability as well.
Yeah, so I think this is certainly an area that is top of mind of CEOs. So I think there's an interesting contrast. Number one, 70-80% of CEOs say this is the top priority for 2026 and beyond, this being how I transform my company with AI. That being said, it's only about 5 or 6% of companies around the world who have really gone as far to translate that technology into higher profitability, higher market share, or other measurable P&L impacts. And so what's the difference? I think we see, what the leaders are focusing on is, number one, it's very CEO-led, saying, okay, this is a top priority for the organization. I'm going to upskill my people. I'm going to upskill myself. I'm going to set very ambitious targets, and I'm going to measure and track ROI. And I'm really going to do that in the areas that are core to my company's competitiveness. I'm going to focus on the core things and focus all my efforts. And that's really what's driving, I'd say, those leading companies from really getting that P&L impact, which, to be honest, today are too few and far between.
Yeah, let's talk a little bit more about the implications for jobs. I mean, do you anticipate seeing job losses as this technology becomes more widely adopted? Or you mentioned upskilling there. What does that look like in real terms, and how do you see the future of work changing?
Well, what we certainly know is a lot of jobs are changing. And if there is one thing that we take away about what's happening with AI right now is it's fundamentally changing how knowledge work is done and accomplished. And if you think about what most jobs today are about, it is about knowledge work. So first, in real companies, what's happening is they are seeing that they do not get benefit from this technology unless they are reorganizing and restructuring their teams. Now, sometimes that means certain jobs go away. Sometimes that means certain jobs are added. But what it certainly means is that all jobs are changing. So what this means is, really, regardless of what the function is, whether it be marketing, finance, HR, all these core functions of different companies, they're trying to get to the same outcomes, but they're doing so in fundamentally different ways, supported by AI tools, and that means those jobs are changing. And so really, I think it's incumbent upon all leaders, right, and everyone inside companies to be upskilling in these areas.
What would you say, the one skill that a frontline worker in a white-collar industry would need to still be relevant in their role in 2028?
Yeah, probably the most important thing is upping your pace of learning, because indeed, what this technology could do 6 months ago is completely different from what is possible today, and that is still completely different to what we may or may not predict is possible in 6 months. Hence, actually, when we talk to CEOs, we find leading CEOs, even at the CEO level, are spending 6 hours per week upskilling themselves on what the art of the possible is. And I think for any worker, we should be spending at least that amount of time per week. So I would say number one thing is upping that pace of learning and making sure one is able to stay on top of what is possible now.
Yeah, the evolution in the space is astonishing, and the need to keep abreast of it very important as well. But do you see some risks to all of this also? Because one of the themes we often talk about is where is the energy going to come from to power all of this? Could that perhaps slow down this revolution?
Yeah. What's certainly happening is that energy is one of the fundamental constraints and also one of the, I'd say, fundamental resources where demand is growing because of AI and the corresponding infrastructure. So indeed, if you look at most power grids, if you look at most plans for energy consumption, they are being moved in material ways because of predictions, whether if you believe the higher the low end of the AI data center consumption going forward. And that also means, right, this becomes a topic of real national interest, where countries are saying, do I have the energy infrastructure to support what I want to do in my country, with AI? And so it is, on one hand, certainly a possible constraint, and also something that is really driving the build out of energy infrastructure, both on the renewable and the non-renewable side.
Another recurring theme is also, are we in bubble territory here? And I was wondering if you could sort of help us separate hype from reality. Are there any pockets of the market where you are seeing hype? And what does that look to you? How do we identify it?
So overall, we think that AI is not a short-lived hype. But if we were to decompose I'd say the stack a little bit. And what do I mean by that? When we talk about AI, we are talking about a few things. We are talking about, as you were alluding to earlier, infrastructure, so data centers. We are referring to silicon, so that's one layer. We are referring to another layer, which is also models, those from Anthropic, OpenAI, DeepSeek, and others. And then on top of that, we're referring to the application layer and how companies are building applications or buying applications to transform themselves. And we have to look at all three of those differently. First of all, there is demand increasing along all three of those layers. So demand is happening. There is investment increasing around all three of those layers. Now, certainly the investments have increased the most at the infrastructure and the model layer. And we have many new players in the market, and therefore we may take 2 steps forward, 1 step back, and there may be some shakeout. That is certainly possible. So we are in the midst of some type of cycle there, for sure. I think at the application layer, which is how companies are buying, developing the software built on these tools to change the way they work, we are still in the very early days. Remember, only 5 to 6% of companies are truly seeing significant impact today, even though the majority are trying. So that part, I think we're at the very early stage of an investment cycle, which is going to take a long time to play out.
You mentioned a few minutes ago that the Asia-Pacific is really leading the world in AI adoption. What do you feel is driving that bottom-up approach compared to Western markets?
Yeah. We, as I talk to leaders here at Asia-Pacific, we strongly have the sense that this is not, say, for example, .com in 2000, where, it's invented in Silicon Valley, then diffuses to the US, and eventually it comes to Asia. There's really a sense here that, we have some of the most competitive markets in the world. We have some of the most ambitious companies in the world, and therefore they have access to this technology, and they are saying, I'm going to find ways to use this to make sure I continue to win in my market. So number one, I think a high level of ambition, right? Number two, when you think of that recipe around what does it take to really happen, and indeed, for companies to transform with AI, indeed it's about the technology, but it's just as much about how am I fundamentally changing jobs, how am I fundamentally changing the way I work across my whole organization, and that requires a lot of top-down initiative and energy and excitement. And we see that from a lot of our leaders in Asia Pacific, right? So I think these things combined are meaning, we would expect how companies are transforming. It's as much news that's going to be made here in Asia Pacific as we're going to see in other parts of the world.
Jeff, I'll just ask you to hold on for a second if I can. I'll come back to you in a moment. We just want to catch the open of trading in India and see how we track here, because there are a few AI-related stocks that we're watching also. If we just take a look at the open, a little bit of softness to get going, perhaps not surprising. We're seeing a risk-off sentiment across the Asia-Pacific region at the moment. But Reliance Industries, one of the stocks that we talked about a little bit earlier, off by about 2.25% at the moment. We did see a lower than expected quarterly profit, soft on petrochemicals and retail retail business as well. Revenue, though, was up 11%, but we're seeing Reliance just slipping a little bit there. Wipro, another one that we're watching, off now 8%, a little bit more than that. This is a company that specializes in IT, computer-related technologies as well. Bit of a mixed bag there, 7% net profit decline, which was worse than expected, although you could probably say a lot of that was due to implementing the new labour code, but shares a bit softer in the first few minutes. They're now off 8.3%. We'll be talking to the CFO of Wipro in a little while. Jeff, on the topic of India, I just want to get your thoughts on what trends you're seeing in terms of AI adoption in that market and how much room you see for growth.
Oh, it's a great question. Actually, when you take a bit of a tour around Asia Pacific and think about, well, in which countries do we see the most ambition, the most adoption? Actually, in Asia Pacific, India and China certainly top the list in our research and when I talk with business leaders in both places. So going back to those key points of, what does it really take to transform with AI? We see leaders in India really thinking about this, really taking action. In fact, I tell many of my colleagues around the world and many leaders around the world, if I were to look at where some of the most, I'd say, forward-thinking banks and other companies in terms of adopting AI, in terms of how they work, you find some of them in India. You also find some of them in China, and you find some other parts of Asia as well, too. But there is as much innovation, happening in that market as we would see in some of the Western markets, certainly.
All right, Jeff Walters of Boston Consulting Group, thanks so much for joining us today with your insights. Let's take a quick look at those Indian markets again, a little bit softer as I described, and Reliance coming in with those lower than expected quarterly profit numbers. The refining and telecoms business was reasonably strong, but overall a little bit of softness there on the share price, although we're off session lows now, off by about 1.7%. And we're also tracking Wipro. This is after the tech giant reported earnings that did fall short of expectations. The company's CFO Aparna Iyer is going to be joining us in the next hour. Those shares now off more than 9%, so we'll have plenty to talk about. Coming up, new polling puts Australia's populist One Nation Party ahead of the Conservative opposition for the first time. We'll have more on this political shift next. This is Bloomberg. Welcome back. You're watching Insights. A new poll suggests Australia's populist One Nation Party has pulled ahead of the main centre-right opposition for the first time. It's a sign of the fracturing of the Conservative vote in developed democracies that might now be emerging in Australia as well. Let's get some more now from Australian politics and economy reporter James Mager in Canberra. James, interesting result in this news poll. What is it telling us about the political mood in Australia?
I think it tells you two things. One, it just confirms what we've seen over the last year, that the Liberal National Coalition, which has traditionally been one of the two, main groupings of power in Australia, has really fallen out of favour. They were trounced to the last election by the Labor Party, who's currently in government. The number of Liberal members of Parliament fell to a just historic low, and this just sort of confirms that they've been able to sort of start to rebuild since that massive electoral loss last year. So the Conservative support rate is slumped, and the One Nation Party, which has been around Australia now for almost 30 years, is really taking away from their support base, and it seems to be building up its own support base. It can also be, there is also probably some effect from the events we saw last year, at the end of last year, where there was a horrific gun shooting in Sydney, where a number of people at a Jewish festival lost their lives, and the One Nation Party, which has been very anti-immigrant throughout its whole existence, has been very vocal in calling for reduced immigration, and very vocal in criticizing what it says caused the things that caused that massacre, and they seem to be capitalizing on that to sort of build support.
Yeah, in terms of the Bondi terror attack late last year, has Anthony Albanese, the Prime Minister, also taken a hit from this? Because in the same poll, we've got the ruling Australian Labor Party slumping down to 32%. So what's the future hold for the Prime Minister here? How can he turn this around?
I think there are two things going on there. With the Labor Party and also with the opposition. One is, that both parties, the Labour Party government especially, has been seen to be, not dealing with the anti-Semitism problems that were in Australia last year, and then have dealt poorly with the aftermath of that shooting. And the second thing I think what you're seeing in a lot of developed nations is that established political parties are increasingly not popular with voters, and voters are going towards the two extremes as opposed to parties in the more traditional centre. And so you're seeing the drop in the Liberal Party support in Australia. You're seeing the drop in the Labour Party support also in Australia. You're seeing more and more independents of various stripes, and that's sort of tracking, but is sort of behind the similar movements you're seeing in the UK, the similar kind of shifts you're seeing in European politics, where Netherlands or Belgium have struggled for years now to form stable governments because the political landscape is fracturing. And I think the thing to watch going forward in Australia is how that happens. Does that happen here? The Labour Party right now is a historic majority, but a lot of those seats are very marginal. And so come the next election, which doesn't have to happen for a few years yet, come the next election, do we see a lot of those Labour Party seats going to minor parties, fringe parties, or hard right parties?
Yep. All right, Australian politics and economy reporter James Mager there in Canberra. Still to come, we'll speak exclusively with Wipro CFO Aparna Iyer after the firm's reported earnings fell short of expectations. Shares tumbling minutes after the open in India. We'll dig into their outlook next hour. Plenty more to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. It is a risk-off mood for Asian markets after President Trump's latest tariff threat on European allies. He's ramping up the pressure to acquire Greenland. US and European futures sliding as traders flock to haven assets. We've got gold pushing to a fresh record high. It's above that $4,600 level. Elsewhere around the region, it's broad risk-off sentiment. The Nikkei at the moment off by about 0.9%, returning from the lunch break there. But it's weakness all around, except for the Kospi, which just keeps on roaring ahead in 2026, now better by 0.9% on the tech story. Elsewhere, though, we've got the CSI 300 in China off by about 0.25%. The Hang Seng down by about 1% as well. We've got the euro hanging in there, though, 116 at the moment, despite all this interesting saber rattling on Greenland. And we had some data out of China a bit earlier as well, which we'll get into in a moment. Mostly in line, the fourth quarter GDP numbers 4.5%, the 2025 GDP number 5%. These are all in line with estimates. It's really only retail sales that was a down note there, expanding only by 0.9%. Industrial output better than expected at 5.2%. Well, those official figures, as I mentioned, they're showing China's economy growing 5% last year. That meets Beijing's target despite a significant slowdown in recent months. China's weathered President Trump's trade war by boosting exports outside of the US. President Xi Jinping signed a sweeping trade deal with Canada last week following Prime Minister Mark Carney's visit. Meanwhile, activity data for December, as I mentioned, showing industrial production climbing 5.2%. That's the fastest in 3 months, just ahead of expectations. Retail sales there, a weak spot, the weakest, in fact, since the COVID reopening, just missing forecasts. All right, let's get to our next guest now, Peiqian, the Asia economist of Fidelity International. Peiqian, thank you so much for joining us today. I just want to get your reaction to those GDP numbers coming in bang in line with estimates, but what do you see happening in the coming 12 months?
Thank you for having me today, Paul. When we look at China's GDP numbers, yes, it's in line with expectations and they're meeting target for 2025. But diving deeper a little bit into the details, we realize that the actual divergence of the economy is wider than what the market has been estimating. The stronger part of the economy, industrial production, export-related activities are stronger than expected for the last few months, while the domestic demand, retail sales, property investments, and broadly fixed assets investment are coming slightly below market expectations. So that just is telling us that the two-speed economy continues to take shape. And looking to 2026, coming to this year, we have seen some earlier policy signals on the intention to rebalance or at least recalibrate the economy on the margin. So narrowing of the divergence is our expectation for 2026, while China still maintains a largely stable growth momentum.
Yeah, I want to get into your policy predictions in a little while, but you mentioned exports there. Do you see any upside or downside risks going forward, depending on how trade talks go with the United States?
Well, I think when we look at China's external demand, we're likely to remain resilient going into 2026 because our base case for the global growth is still somewhat of a reflationary trajectory. So that is perhaps going to still provide a decent support to China's export performance. And in terms of the structure of China's exports, it has also been restructuring into more of intermediate and capital goods exports, which will likely to remain resilient for a multi-quarter rather than more volatile to the tariff headlines. And lastly, I think U.S.-China trade truce is probably going to last for a year. Given that assumption, China's exports is perhaps going to still remain resilient in 2026.
Yeah, and on the domestic side, I mean, we do have those retail numbers, perhaps the one dark spot, although it wasn't even that bad, 0.9% growth. Do you expect more support coming for consumers in China?
I think more support is needed based on the headline numbers we have seen. So consumption has been somewhat lackluster. We do not see much worse or deterioration in terms of property performance or consumer confidence index. But I think for domestic demand to pick up more strongly, we definitely need to see more policy support targeted to support the household in order to restore the confidence and lift the domestic demand going forward.
Well, Bloomberg is running a story at the moment about how China's households are sitting on $7 trillion worth of term deposits at the moment, which are going to be maturing this year. What do you feel needs to happen to make those households spend or invest with more confidence?
I think one important concept to highlight is that an enormous amount of savings in terms of deposits is not really going to translate directly into spending, but rather I think we probably need to see a wholesale or systematic improvement in households' balance sheet in order for us to see much more growth in terms of the domestic demand. So on that aspect, I think a much more systematic policy package should be adopted to see a domestic demand improvement. And that includes putting a backstop in terms of policy in property sector so that the wealth impact doesn't get dented further. And secondly, we probably need to see more social safety nets being put around the households to make sure that the household is more confident to unleash that amount of deposits into spending. And lastly, perhaps it's the sentiment aspects. It could come from multifacets. For example, a stabilization of growth might be restoring confidence on the margin, and asset market performance, if that continues to come in a positive momentum, it will also likely to restore household confidence over the longer term.
Well, another piece of data that we got today was fixed asset investments. And, you mentioned property there. Well, the slide in fixed asset investments tracked the slide in property as well. So to what degree does China's property woes just continue to cast a shadow over the rest of the data and sentiment more broadly?
I think this restructuring of the economy is going to take a long time, and we've been fourth, fifth year into the property sector adjustment. We don't really see the case of a much worse deterioration going forward, but the real question really is when does the policy comes into place to restore and stabilize the property sector investment at the current levels. Given that property sector is no longer viewed as a main engine of growth, I think the cyclical upturn for fixed assets investment might come from other aspects such as the infrastructure investment and a continued performance from the service sector investment, as well as to some extent manufacturing investment stabilization.
Yeah, well, let's talk about industrial production on that note. That was a bright spot, expanding a bit faster than expected on year, 5.2%. Do you see that trend continuing, and how does that fit with another narrative, which is overcapacity in China's economy?
Yes, I think there is still more runway for industrial production to remain strong, and that is given the nature that China's manufacturing output has been a main anchor of global manufacturing supply chain. As we have argued earlier, that domestic demand is probably not the main driver of China's industrial sector and manufacturing sector outperformance. It hinges more on the global demand. So if we think that the global demand is going to remain resilient, perhaps there's still some room to run for China's industrial production.
You were talking about the K-shaped economy a little bit earlier, and some of China's homegrown tech names have been performing extremely well, particularly in the AI space most recently. To what degree do you see those businesses providing a tailwind to China's economy?
Well, I think this K-shaped economy is actually a phenomenon existing across Asia, given that I've been looking at other countries as well. So the AI-related and non-AI-related supply chains are now seeing divergent performance. So on that perspective, I think given that the AI capex remains strong, estimates has been optimistic, there is room for optimism for the AI-related supply chain as well as the demand coming from there. But really, it's about the transmission of that optimism and profits into other parts of the economy in terms of seeing jobs improvement, wage growth, and probably that's going to be the focus that we will be looking at for the coming quarters.
Well, I did say I'd like to talk to you a bit about policy, so let's do that now. We've got a policy decision coming up tomorrow, the loan prime rate. Do you see that being moved anytime soon, or do you think policymakers would prefer a different lever in terms of monetary policy?
Well, given that we have heard quite a few targeted easing last week, the PBOC has been announcing a few very specific rate cuts for relending, for structural monetary policy tools. The urgency or the need for cutting broad-based benchmark rates might be lowered. So just in terms of the very near term, we probably expect the LPR for 1 year and 5 year to remain unchanged for now. But going forward, I do think that we probably will see monetary policy easing continuously, providing support to the economy. Given the constraints of currency and FX stability has been reduced somewhat with renminbi appreciation, there's room for the PBOC to be cutting rates further. So we expect perhaps another 10 basis point rate cut in 2026 and another 1 or 2 triple R cuts for the rest of the year.
And how do you view that impacting the fight against deflation, and how have policy measures on that front been so far? Do you expect to see more?
I think that the PBOC has been in the past few monetary policy statements putting fighting or restoring inflation as one of the policy priorities. It's very likely that there will be more easing in form of both broad-based and targeted easing to bring inflation back on track. But PBOC does have its constraints as well. We mentioned earlier, currency has been a constraint, which is less so right now. But the other aspects of the constraint is really the bank's net interest margins. So the PBOC will probably still going to balance among the multiple policy goals, the FX, the NIMs, and restoring inflation to bring it back on track.
Before we let you go, Peiqian, I just want to get your thoughts on the direction of travel for the yuan. It's been strengthening. It's a little stronger again today, 6.9578 now. Where do you see us heading in the coming quarter?
I think the appreciation momentum will likely to continue based on a few factors on the background. The current account surplus is running at a very high level, and we do see more exporters FX conversion in the last few months. It might continue going into the Chinese New Year as more profits and receivables are converted into yuan. Going forward into the later half or the 2026, I think that given that weak dollar momentum is likely to continue, and that's going to support yuan on a dollar-yuan basis. And in terms of the pace and momentum, the PBOC might prefer a stability of gradual appreciation rather than any rapid moves, in my view.
All right, Peiqian Liu of Fidelity International, thanks so much for joining us today. Staying with China, as we mentioned earlier, households there are also searching for higher yielding investments, as roughly $7 trillion in time deposits going to be coming due this year. For more, Asia Equities reporter Charlotte Yang joins us. So, Charlotte, where's all that money going to go, and how could it potentially reshape Chinese markets?
Yes, Paul, we're looking at a massive figure there. Around $7 trillion of savings deposits are likely to due this year. And Chinese households in the past, they've liked to park the cash in the banks because property is weak, stocks weren't returning, aren't really delivering. But now with deposit rates slipping to 1%, they're also looking at other venues to put their money. And the shift is already happening. We're seeing some of that going into equities. You have the Chinese market adding more than $1 trillion in market value over the past months. Gold is also another venue that's hitting record highs. We're also hearing from contacts that there is very strong demand for those insurance policies that provide steadier yields. So while it's important to know that historically, UBS says that over 90% of these mature deposits will stay in the banking system. But what's important, I think, is what those additional flow will mean for the market. For example, for equities, that could be a real tailwind. The liquidity-driven rally has been so strong recently, but we also need fresh powders going into it. And I think this also goes into what authority has been wanting on a slow bull market, that's steadier, and also to have a healthier capital market that could actually support the broader economy better. So I think all of these, so where these money will go is a very important trend to watch.
Well, China's tech stocks are off to a pretty strong start in 2026, and that's despite a few struggles there. Where do you see that heading?
Yeah, so investors, this year has been so strong for Chinese tech stock. Investors are just now not really paying much attention, to the macroeconomy that's struggling, but instead focusing on all those exciting developments we're seeing across China, be it AIs or, flying cars or commercial rockets. So the Chinese tech stock this year actually had a stronger start than the U.S. peers. Onshore gauging in the mainland is up more than 10%. In Hong Kong, it's about 6%. So what's really the key catalyst here is those enthusiasm over those homegrown technology. And looking ahead, you also have catalysts. DeepSeek, it's expected to roll out a new model this quarter. And in March, you also have more details on what Chinese authorities are thinking about, the key policy priorities when it comes to tech for the next 5 years. While valuation has become a challenge to some given the rally, for example, Cambicron is now trading over 100 times PE. But with that said, I think so long as we could see more exciting developments coming and also the earnings keeping up, investors feel like this is a long-term structural story to play.
All right, Asia Equities reporter Charlotte Yang there. Still to come this hour, global political and business leaders are descending on Davos for the World Economic Forum, geopolitics taking centre stage. This is Bloomberg.
There's no good news here. If people stick to their positions, and right now it looks like they're going to, we could be heading for at least an economic confrontation. I hope it doesn't lead to the end of NATO.
I am fairly confident that the administration wants to avoid any sort of military conflict, hence this level of engagement with foreign partners about reaching a solution.
Once the discussion pivots towards the rare earths and start really getting at the meat of what's desired here, and commitments and negotiations can start form around something that appeases the White House, we could see some quick movement there. As long as President Trump can save face, claim victory, I think we can get out of this.
Some of our guests there reacting to President Trump's threat to tariff 8 European countries unless there is a deal for the purchase of Greenland. And President Trump posting on Truth Social a short time ago saying NATO's been telling Denmark for 20 years that you have to get the Russian threat away from Greenland. Unfortunately, Denmark has been unable to do anything about it. Now it is time and it will be done, and those are 3 exclamation points there. Well, Trump's latest comments come ahead of his visit to Davos for the World Economic Forum. Bloomberg News Chief Asia correspondent Rosalind Matheson joins us now with more. So, Rosalind, how's this Davos going to be different for President Trump compared to previous ones?
Well, of course, a year ago, everyone was watching Trump also speak at Davos, although he spoke virtually, and that was to get an early sense of what his second term as president was going to look like. And now we've had a year of, just a man who's in a hurry, really, to do a lot, whether it be on trade, on defence, on security. He's really upended a lot of norms. He's challenged Congress at home, and he's really gunning for a fight, it seems, with Europe, especially over Greenland and on trade. So he's going to come into Davos, it sounds pretty hot, full of messages again about US strength versus European weakness, for example, talking again about his desire to own Greenland in some fashion. The question is, what are we going to get behind the noise and the bluster and the rhetoric? Is there going to be anything tangible that he says off the back of his latest threats, for example, on tariffs? And what is Europe going to do at this meeting and beyond to counteract some of that? What are their options on the table? How hard are they going to go? So it'll be about the signalling from Donald Trump about where he sees the world going, according to Donald Trump. And where does Europe see its role in trying to soften some of that rhetoric and some of the things that he's saying? So it'll be very interesting to watch the tea leaves in all of that. And, of course, a lot of other players at Davos too. I mean, there's the question of China and what it's going to be looking at from this meeting.
Yeah, let's talk about the reception that the president might face when he gets to Davos. Is there the potential for any hostility there from European leaders?
Well, certainly the rhetoric has been a bit stronger in recent days in the aftermath of his tariff comment about Greenland. And you can see European leaders grappling again amongst themselves about how strong to go in their response. In the minute on the ground, are they going to come out swinging against Donald Trump? Possibly not. I mean, there are calls for them to show a much stronger response, but equally they might say, well, hang on, we're not sure if these tariffs are going to take effect. We don't know how they would take effect. Even if they do take effect, will the court potentially strike them down in the US pretty quickly afterwards? So do we want to perhaps hold our fire a little bit to see how that goes? But they're probably still convinced in some fashion that they can negotiate Donald Trump off the ledge on some of this, without resorting to a fully blown EU-US trade war, for example. And can they negotiate with him on Greenland? Can they negotiate on trade more broadly and security in the region? And of course, in the background is the fact that they've still not got a peace deal on Russia's war in Ukraine. Is that still somehow on the table? Does Europe try and engage on that? The reality for Europe, though, is Donald Trump even interested in listening to what they've got to say. He tries to cut them out of a lot of negotiations to negotiate bilaterally with Russia, Ukraine, perhaps Denmark and Greenland. Does he want the Europeans out of the picture entirely? So they'll probably be trying to manage all of that, and we'll see how the rhetoric looks in the minute.
Well, a lot of CEOs and business leaders, of course, present at Davos as always. What are they going to be wanting to hear and achieve?
Well, certainly if you're a US executive, you want to hear Donald Trump talking even further about America first and the benefits that he says he's bringing US companies around the world. He's talked a lot about trying to level what he says the playing field for US companies abroad and to bring manufacturing and jobs back to America. And that's kind of been music to a lot of ears of CEOs in the US, including tech CEOs who are quite happy the fact that he's taking on the EU over their regulation of technology companies. So they want to hear about that. Perhaps any further plans to try and draw some of the reliance away from China when it comes to critical minerals. What are his specific plans around that, for example? What about AI and so on? But you've got the counterpoint also of European CEOs at this meeting wondering how they can diversify their trade. Perhaps CEOs from Asia at this meeting wondering similar, like what are the tea leaves for them in terms of the need to diversify their supply chains and their markets further, including potentially away from the US.
All right, Bloomberg Chief Asia correspondent Rosalind Matheson there. And here's a look at some of the big names we're going to be speaking with this week from the World Economic Forum in Davos. We'll talk to government officials, including the finance ministers of Japan and Hong Kong, CEOs from across corporate Asia, and leading investors as well. Coming up, Jane Street back in court in its dispute with India's regulator over alleged market manipulation. We'll bring you the latest details on that story ahead. This is Bloomberg. Welcome back. You're watching Insights. Shifting focus to India now, where Jane Street is set to head back to court today. The company claims it was denied access to crucial documents it needed to defend itself against the regulator's allegations of market manipulation. For more, let's bring in Bloomberg Asia Equities reporter CJ Chakraborty in Mumbai. So CJ, what's at stake for Jane Street today at the appeals court?
Well, Paul, it's a crucial day in the saga between Jane Street and India's securities market regulator. Jane Street is seeking critical documents that it feels are crucial to making its case to the regulator that will allow the proceedings to go ahead further. At the same time, SEBI feels that they have provided all the evidence and all the procedural documents that they could related to the case that are relevant to the case at this point of time. Now, it is in the hands of the appellate tribunal, the appeals court in India, to decide whether Jane Street is in the right or SEBI is in the right, and that is probably what we might come to know later today.
So, based on today's outcome, how important is it in helping the case progress?
Well, it's very crucial. Let's not forget the case has been, stuck in limbo ever since Jane Street first filed its appeal back in September. Until and unless this appeal is sorted out, the proceedings at SEBI's end cannot continue because it is waiting for Jane Street to formally respond to the interim order or the initial allegations of market manipulation it had raised against the company. And therefore, today's hearing would go a long way in helping this proceedings, the case, continue forward.
So tell us about the documents that Jane Street is seeking to access from SEBI, and how is this going to help them?
Well, the list of documents is quite long, Paul, but two crucial information that it is seeking is A, they want the email conversations between the regulator as well as the National Stock Exchange of India, which is the largest stock exchange here, in relation to the case. Apart from that, they are also seeking email exchanges between the regulator as well as a market participant who had raised complaints and allegations against Jane Street's trade in India. Jane Street feels these two pieces of documents or a set of documents could be quite crucial to its defense when it comes to the interim order, whereas the SEBI's argument so far has been that all of these documents are personal and private conversations that cannot be shared without explicit consent of the related parties.
All right, Bloomberg Asia Equities reporter Chiranjeevi Chakraborty there in Mumbai. Let's just take a quick look at how Indian markets are tracking at the moment. It's pretty much a risk-off day across the Asia-Pacific region. We're seeing that reflected in those major markets there as well. The Sensex off by 0.7%. The rupee still pretty weak against the dollar. A few market-specific stories as well. We'll be talking to the Wipro CFO shortly. That tech company saw a 7% net profit decline. Reliance also had a lower than estimated quarterly profit, also with petrochemicals and the retail business sluggish, so that stock losing a little ground also. Now, we're also watching Indian bank shares after a weekend full of earnings. HDFC Bank's profit beat estimates. ICICI, though, missed. South Asia breaking news editor Harshita Swaminathan has more from Mumbai. So, Harshita, give us a rundown of the bank earnings over the weekend.
So we had HDFC Bank and ICICI Bank reporting over the weekend. We saw pretty good loan growth from both of them, around 11.5 to 12% respectively. if we look at the macro factors as to why they are growing so well, first is, of course, the central bank's rate cuts. We've had 125 basis points of easing so far in this cycle. And additionally, around 100 basis points of cuts to the cash reserve ratio. So the combination of that is, of course, leading to fair bit of loan growth at the banks, and it's also the October to December quarter, which is the festive season quarter, and there's of course a seasonality aspect to it, and the banks did say that mid to small enterprise loans were the biggest drivers of growth for them. So looking at HDFC Bank first, the bank is emerging from a period of a deliberate slowdown where it purposely grew its loans much slower than it could have, so that it has time to beef up its deposits and liquidity buffers. And now with the most recent earnings, it looks like their loan growth is back up to at least the system average level. So investors are viewing that very positively. As for ICICI Bank, the main earnings missed estimates because of a provision that the RBI asked it to make, but it did reappoint its CEO for another 2 years. So that's being viewed very positively.
So tell us about the outlook then. What does this mean for the bank earnings going forward?
Well, at least over the weekend, it seems to have been a mixed bag, although HDFC stock is doing much better today. The key positive thing, of course, is that loan growth is back up to what the bank would normally be able to do if it weren't trying to deliberately slow down. So that is good. And the CFO also said that in the next financial year, the bank would be back up to growing above industry average level. So that's being viewed positively. As for ICICI Bank, the most important part is the CEO's reappointment. His CEO Sandeep Bakshi's term was due to expire later this year, and he is a guy who's viewed very positively by the markets. So his reappointment for another 2 years removes a key overhang, a key uncertainty for the stock, at least for the time being.
All right, our South Asia breaking news editor Harshita Swaminathan there in Mumbai. Coming up, Wipro CFO Aparna Iyer joins us exclusively as the Indian IT services company reported earnings that fell short of Welcome back. You're watching Insight. President Trump is pushing to force tech firms to effectively fund the building of new power plants to help fuel the AI build-out and counter surging consumer electricity bills. U.S. Energy Secretary Chris Wright spoke with us on the progress of talks with AI companies.
Since we arrived in office, I have engaged with the top leadership of all of the large tech companies, all of the people that want to develop data centers, and we've just discussed about how we can get power quickly for them and how we can do it without driving up electricity prices for Americans. In fact, I think they're going to be great catalysts to stop the price rises we've been suffering and ultimately to push down electricity prices. But yeah, tremendous interest from the large developers. They know what needs to be done and they're willing to do it.
Is the administration looking into any way to force their participation? Are you going to say you can't build data centers at all if you don't participate in the power generation or offsetting the costs?
It isn't a matter of force. They want to develop a data center, so they've got to do whatever conditions are required to get permits and to be able to build a data center. But I would say that our relationships and negotiations with them have been extremely productive. They understand the need that we need to stop rising electricity prices on Americans. They get it. They want to build the data centers. Electricity is a cost item for them, but it's nowhere near their biggest cost item. They're willing to do what's necessary to get the right answer for Americans.
And then I believe Secretary Burgum touched on this, but how are you deciding which companies would be taking place in this? Are we only talking about hyperscalers, or are other developers going to be involved too?
All developers. Everyone that wants to bring a new large load. We're going to see large manufacturing plants. We're going to see a giant aluminum smelter come to the United States. We're going to see large-scale manufacturing. So it's not just data centers that are going to bring new electricity load to the country. We're going to see a lot of it. And that's, of course, exactly what we want to see. We want to see America reindustrialize. We want to see jobs and opportunity. And so everyone is involved in that dialogue about how do we grow our capacity to allow this reindustrialization.
US Energy Secretary Chris Wright there, speaking with our colleague Tyler Kendall. And we'll have more on the impact of the AI boom on energy in the region in the next episode of Bloomberg Tech Asia. And that airs this Friday, 8:30 a.m. if you're watching in Hong Kong, Thursday, 7:30 p.m. if you're watching in New York. Here are some of the other stories that we're following. The Sequoia Capital is reportedly planning to join a $25 billion funding round for Anthropic that would more than double its valuation. According to the FT, the round led by Singapore Sovereign Wealth Fund GIC and Coatue values the AI firm at $350 billion. The two lead investors are said to be contributing $1.5 billion each. Anthropic has yet to decide which investors to admit into the funding round, which may close in a few weeks. Chinese solar giant LONGi warns of another full-year loss as the solar panel slump drags on. It expects a net loss of about $861 million to $933 million, hit by weak prices and rising costs. Bloomberg Intelligence says LONGi could rebound this year as the industry moves into an upcycle. The company, which is the largest solar panel maker in China by market cap, has been facing overcapacity and pricing competition. The Korea Exchange is in talks with financial authorities to ease rules that ban high-risk leveraged exchange-traded products. The move aims to draw retail investors back to the domestic market and align the framework with leading international stock markets. The bourse's CEO told Bloomberg they expect asset managers to move quickly to list more leveraged ETFs locally once the ban is lifted.
To move forward with this, certain legal and regulatory revisions are required. We are currently in close consultation with policy authorities on how far those amendments should go. As such, it is difficult for me to give a definitive timeline at this stage, but I believe these measures are likely to be institutionalized in the near future.
And we're tracking moves in India's IT names after Wipro reported third quarter profit that fell short of expectations, while sales came in slightly ahead of consensus forecasts. Wipro also provided fourth quarter guidance, expecting sales in a range of $2.64 to $2.69 billion. The top end is ahead of consensus expectations for $2.64 billion. Well, joining us exclusively now is Aparna Iyer, CFO at Wipro. Aparna, thank you so much for your time today. And I just want to start with your key takeaways from that earnings result. A 7% net profit decline, that was worse than expected. But how much of that was due to one-off restructuring costs, also charges linked to the new labour laws?
Yeah, if you look at it, we took a charge of about 302 crores rupees in our P&L as a one-off provision. Whatever we had to take has been taken. There is absolutely no impact on an ongoing basis. And adjusted for this, our net profits actually grew sequentially over around 4%, and it was flat year on year. So yeah, that was a significant charge that we had to take. Apart from that, we also took a charge towards restructuring of few of our associates in largely the European geographies, and that was also about $35 million or so. So these both are non-recurring in nature. And when you adjust for that, our net profits actually grew quite well. On the back of our operating margins, actually, our operating margins have shown consistent improvement and came in significantly higher, about 17.6%. Most of this is operational, no one-offs. And we are hoping to sustain this in a narrow band going forward.
Yeah, tell us a bit more about your operating margins. They did jump despite some pretty soft growth. So do you feel like that's the new normal, or is this margin protection in a soft market?
We've been on this journey for the last 8 quarters, Paul. We've been improving our operating margins consistently over the last 8 quarters, and all through in the backdrop of a very weak revenue environment. Goes back to just operational rigor and resilience. We are very, very focused on making sure we are deploying AI in all our fixed price programs, so fixed price productivity, maintaining an optimal level of utilization, and optimizing your overheads, including SG&A. So I guess all of that has played out, execution rigor throughout. And that's something we are very happy with the band we are at. 17 to 17.5% was the band we had called. Today we are perhaps at 17.6, which is a recent high in last several years. So we're quite happy with the margin performance. I think that leaves us some room for investments. We have acquired a Harman DTS, which has 1 month, was consolidated in Q3, and we're expecting 2 months of incremental revenues to flow in Q4. And so we are continuing to invest for our growth.
Talk to us a little bit about IT services revenue as well. It grew just 1.4% sequentially in constant currency basis. Do you see the strengthening, or where is it still weak?
If you look at it, our 1.4% sequential growth in constant currency, 0.6% of that was organic in a very seasonally weak quarter. Q3 typically many of our clients have furloughs. So I think 0.6% sequential growth is fairly strong, and the growth was very secular. If you look at it, 3 out of our 4 market units grew sequentially, and similarly, 4 out of our 5 industry verticals grew. So it was a fairly secular growth, organic, and I do think that we are building back strength relative to where we started about a few quarters ago. So we've been progressing. We are having more and more market units which are showing sequential growth and year-on-year growth, and we're making progress.
Your fourth quarter guidance for IT services is also quite weak, 0 to 2% for IT services business. That does seem a bit conservative. Why is that? What's the logic?
I think we always guide based on the visibility we have at the start of the quarter. There are 2 factors playing into it. One is certainly, the furloughs typically come back in Q4, adding a nice bounce to the revenues. But this time, the number of working days is fewer. So that's almost offsetting the furloughs that typically come back in Q4. So lower working days is one. And some of the large deals that we had won earlier this year are taking a little longer to ramp up. Those are the 2 reasons why our guidance for Q4 appears softer as those deals ramp up.
Total bookings are also a bit weak, 5.7% on year. Large deals are also under $1 billion. Can you talk to us about what's happening here? Is this a pipeline issue, or are investors sort of slow walking signing to completion?
No, actually neither. If you look at it, typically large deals are binary in nature, and they do take a little longer to close, and some of them just tend to lump up. So if you look at our bookings performance outside of the large deals, it's fairly good. It just appears like, because we had 2 very good quarters of large deal bookings with like 4 mega deal wins in the first half. So when you look at the performance sequentially or a year-on-year, it may appear softer because of the lower large deals. But if you look at it just year to date, and that's what counts, and that's what will drive the performance in the next few quarters, our bookings have grown year-on-year quite well. Our large deals booking have grown over 70% year to date, and overall bookings is also growing north of 20%, 20-25% year-on-year. So that's a healthy growth.
We need to talk about the AI story as well. It's central to your pitch. Do you feel, to what degree is this driving new spending, or are you moving around existing budgets?
Actually, AI is leading to newer spends. And if you look at it, our clients are very, very focused on spending on AI. It is certainly right up there on the mandate. It's a board mandate. A lot of business and CEOs have their attention on this. Typically, the way we've seen this play out is 2 ways. One, clients continue to focus on cost optimization and creating to invest in AI. So it's a two-pronged approach. So drive efficiency in your core, create that headspace, and put that investment back into new AI spends. We see both trends play out quite well. If we've always said for the last 3 or 4 quarters that the pipeline is dominated by deals where clients are looking at vendor consolidation, cost takeout, efficiency, and a lot of all the dollars that get saved gets put back into AI, and those spends are happening as well. So we've got opportunities on both ends. When it comes to cost takeout and optimization and efficiency, it's a huge opportunity for us. And similarly on the new AI spends.
You don't disclose AI-specific revenues, though, which does beg the question, why not? Are the numbers not exciting enough to talk about yet?
It's not about we're quite fairly regulated and we want to be very careful about what we call as AI. There is no one industry definition. The way we look at it is AI is fairly pervasive. Like every deal, I spoke about how cost takeout and efficiency, we do bring in newer ways of delivery. We've got 2 delivery platforms, Wings and Vega, under the entire Wipro Intelligence umbrella, which basically includes all our AI initiatives. It has delivery platforms called Wings and Vega, which are embedded into every deal that we are contesting in the pipeline, whether it's a renewal or whether it's a net new, right? Because if it is about support, maintenance, managed services, we've got Wings. It's about development, transformation, the software development life cycle, we've got Vega. So it is embedded in every opportunity that we are chasing today. So it's very difficult to differentiate that this is pure AI and this is infused AI, and then, lack of a standardized industry definition just keeps us out. But we do track those numbers very carefully. We look at the work orders that have AI infused in it. We look at people training as to how many of our associates are, it all started off with the basic AI training, then the advanced, and now how many of them are completed masters. And we are making sure that most of our delivery people are completing. So there are various ways to measure this, and it's very pervasive. That's why we're not calling out one number.
Okay. Aparna, before we let you go, we've got about a minute left. I'm just wondering if you can tell us about the impact on costs from US visa restrictions, because fees for H-1B visas are higher. Have you had appointment disruptions? Yeah. Can you tell us about what's going on there?
So far, so good. As far as our own operations are concerned, we've been fairly localized, and our H-1B dependence has been coming down year on year for the last 10 years. So we were pretty well prepared, even as there was a change in the law. And we're not really seeing a big disruption. There is some increased scrutiny, but that's right now manageable. And we're not seeing any big impact, neither operationally nor on our financials. We feel we are quite well boosted to meet the supply.
All right, good stuff. Well, thank you very much for joining us, Aparna. That is Aparna Iyer, CFO at Wipro. Before we go, let's take another look at some of the big names we're going to be speaking with this week from the World Economic Forum in Davos. We'll be talking to government officials, including the finance ministers of Japan and Hong Kong, CEOs from across corporate Asia, as well as leading investors. Lots of conversations for you to catch up on there, and it all starts on Tuesday. But that is it for Insight. Horizons Middle East and Africa up next. This is Bloomberg.